Welcome to Digital Look TV. I'm Mary Rose Fison. Today I'm joined by Georg Grodzki, Global Head of Credit Research at Legal & General Investment Management, which oversees £350 billion. Georg, thank you for joining me. Let's start by talking about developments in the fixed income markets. Over the past 6 months, we've seen spreads narrowing somewhat, but still the 10-year bond yields in Portugal, Italy and Spain are above average. Is fixed income still an attractive option for retail investors?
Well, what are the alternatives? You definitely don't want to hold your cash with the bank. A, it doesn't pay very much, and B, in fact, as we have seen, even banks can get into trouble. Equities are looking fairly valued, given that earnings, as you have seen in the last few days, are not rising through the roof anymore, and therefore fixed income, despite the fact that yields are much lower than where they were a year ago, fixed income still seems to offer some residual performance prospect, and that explains why the recent bond issues by corporates but also by European sovereigns were snapped up.
In the past month and a half, Italian bond yields have fluctuated wildly as the country has moved through a political gridlock. Now that Enrico Letta has been sworn in as Prime Minister, how do you see the bond yields in Italy changing in the months ahead?
Experience has shown that most of the time new governments are being given the benefit of the doubt for, say, up to 3 months. And there is certainly some sense of relief in the market that Italy has a government, and this government seems to have a broad base in the parliament such that it doesn't look likely to fall over again at the next hurdle. So therefore the markets are now comfortable with the situation much more than they were a couple of months ago. It looks as if the newly elected Prime Minister and his government will try to ease a little bit the path of fiscal restraint, which is something which the markets probably quite like to hear and see as well. But he's not going to do that in a way which will throw overboard all the lessons learned a few years ago. So he may actually be not a bad choice and pursue policies which are the right mix for everybody. So I would guess that Italian bond yields, barring any major surprises, will perform reasonably well on the back of the appointment of the new government.
In Spain, we've seen a really high deficit, increasing unemployment and a weak economic growth. What are the prospects for the bond yields there, and what are the likely contagion effects for neighbouring countries?
Overall, I would say Spain is in a slightly more challenging situation. Yes, their government has been in place for a while, and has also at least another couple of years to rule, but the economic challenges are formidable, and even more so than in Italy. Why? The housing market, as we have learned from one of the leading rating agencies, will apparently take another 5 years to find a bottom. The overhang of unsold complete homes is weighing on the market, so construction activity is going to remain subdued. B, the banks are still challenged and are unlikely to provide much support to the economy, and we have this army of unemployed people who are desperate to find a place in the economy, but I don't see the uptick in corporate investment in the near term, which could employ these many youngsters in particular. And so the mood in Spain will probably get more tense as we go through the year, and the sense of unease will probably rise, and it will put the government to the test.
In June, the German Constitutional Court is due to rule on the European bond buying programme and whether it needs to be amended or not. Could you talk me through some of the possible scenarios we might see following that ruling?
The Constitutional Court may put an upper limit on the amount of bonds which the ECB buys of certain governments, so it could put in a figures such as X billion euros, which is the ceiling. The Constitutional Court may also say that the ECB can only intervene in favor of certain governments if much tighter conditions are in place than at the moment. The Constitutional Court may simply also say the German constitution may have to change in order to make it compatible with what the ECB wants to do, which would require a very big majority in the German parliament, and that's possibly not forthcoming. So a number of hurdles or roadblocks could be put in the way. It feels as if a plain yes and a blanket endorsement of the ECB's ambitions is less likely than some conditionality which could produce a major headache for certainly the German government, but also for other European governments and the ECB itself.
Thank you. Well, that brings us to the end of this episode of Digital Look TV. Georg Grodzki, Head of Credit Research at Legal & General Investment Management, thank you very much, and thank you for watching.